that signifies ownership in a corporation and represents a claim on part of the corporation's assets and earnings. Okay, what are the disadvantages of stocks? Since we're in a learning environment, I mean, even as a veteran in terms of trading, I learn from the marketplace still on a day-to-day basis, not just from the markets, but also from my students, also from you guys. One of the disadvantages of stocks is basically having the capital. Like if you are starting out, you will need to have a good amount of capital to be profitable. Not everybody will have a minimum of 25,000, 50,000, or 100,000. Last week, actually, I got approached by one guy. He just lost pretty much, 70 to 80% of his 401k. 401ks is similar to self-managed super funds if you live in Australia. And so what happened as well from there, he let others basically trade his 401k and hence lost a big chunk, and now he wants to get everything back. Now he's basically new to the game, started reading, started trading, and now he's down basically 80 to 90% of his 401k. And that's hard. That's that's difficult because he's retired and now he's under pressure to perform. He wants his money back. So once you're in that state, it is more challenging. Now he starts trading stocks, and hence that's why he's having a lot of problems with that. Two, you need a good solid knowledge base. In the stock market, you just don't go based on technical analysis, well, I'm going to buy Apple, right? You need to know what sector Apple is, and plus in terms of rotation, they do rotate. Sectors in the stock markets, they rotate, so you need to know all this as well. You need to know macro fundamentals when it comes to the stock itself. I'm not talking about the micro fundamentals. I'm talking mainly of the macro, what the price of, say, Apple is being dictated. Technical analysis, risk management, money management, profit maximizing strategies. You need to be your own psychologist. You need to be your own market maker, everything, right? So it is pretty tough if you're starting out. Three, you also need to decide whether you have to be a day trader, momentum trader, or swing trader. Is it going to be another job, or is it going to be a freedom of time? So pretty much which one. Four, it is expensive in terms of commission costs. You will need a certain amount of profit to offset the expenses. So for example, this is taken basically through E-Trade. They do charge $7 in and out, right? One in, one out. So that's $14 already. If you're going through via the phone, it's $32, or via brokers, it's also $32. Five, part of the taxes, right? You need to know, if you're trading stocks, you need to know the tax rules. Now, if you don't have a good accountant, it will be very, very challenging as well, putting everything all together by the time tax season comes. Six is about the time. If you live in the Pacific, based on Pacific Standard Time, then you need to wake up at least 5:30 in the morning if you want to day trade on a daily basis. Now, what if you have a family and you have to go to work? Can you really do this consistently by waking up at 5:30 in the morning? Seeing thousands of traders, the majority, almost close to 100%, they cannot sustain the 5:30 in the morning. So when it comes to swing trading, on the other hand, if you live based on the West Coast or any part of the world for that matter, then can you take time off at 1 o'clock? If you live in the East Coast, then even better, it's much better. But what if you live, say, in London, or you live in India, you live in Australia, or any part of Asia? Right, a good, depending on what environment you're trading in, you need these times in order to be focused, in order to create a plan, probably creating a plan even prior, the night prior to that. What if you come home way too late? What if now if you have to cook dinner and to look after your kids and so forth? So it is very challenging. Time is very valuable. Money. As mentioned to you before, by SEC rules here in the US, you need a minimum of $25,000 if you want to start day trading. So if you're starting out with little knowledge, skill, and experience, the odds you will lose the whole amount is highly probable as well. Terry Odian, who is based from Berkeley, created research based in the financial industry and found that 100% of the time of day traders will lose all of their capital. That is very high. And I'm not here if you're a novice and you're here just to find out more about trading. I'm not here to scare you, but these are the actual facts. 8. Trading stocks is not really ideal as a learning process. Why do I say that? So if you have minimum to no trading skills, experience, and knowledge, the odds you're going to give all of your money to the markets are highly probable. When you're in a learning environment, you should be focused more about your investment to yourself based on education. That is in my personal point of view. I was just fortunate that when I started, I went through a proper education. I didn't learn by myself because I believe that if you want to do things right, then you need assistance, you need help from someone who knows what they're doing. Like being an athlete, there's no way that, for me to compete at a national or even international level is also by learning by myself. No. It's a team effort. Obviously, you have to put time into it. If you really want to win, then you need to put time to yourself, and you need good coaches or people, or in other words, a good team environment who basically has also the mindset of being successful. So if it's a blind leading the blind, if someone's not successful and basically teaching you unsuccessful trading systems, then you won't be successful. What if that person is also very negative and doesn't motivate you? So now just imagine if you're doing it by yourself, who can motivate you? Nobody else but you yourself. Okay, 9, gaps. I don't like gapping in the marketplace. You saw that basically this week. It was inevitable, it was predictable that the market had to correct itself. It created a new high, and then after that report, it was hovering around, it was really nice, and then out of nowhere, boom, big boys came in and sold, which created a lot of fear in the marketplace yesterday, which the level of demand, and out of nowhere came back about halfway pretty much from yesterday's big move to the downside. So the market's just hovering between two midpoints at the moment. And for the Dows, between 13,800 and 14,000, a 200-point move. So the question is, can they really push that down to have a bigger correction? Maybe, maybe not. It all depends on what Bernanke is going to say tomorrow and even Friday, right? So this week is a very volatile week. But in terms of gapping, now if you're basically long, say for example, this is an example of Apple, if you're long over there and part of that, it's still in a downtrend, you're screwed. Part of that gap, there is no guaranteed stops in the stock market, unfortunately. 10 is about leverage. Yes, it's a 4-to-1 for day trading. Some brokers can offer bigger leverage, but this is also risky if you have minimum to no experience trading the stock market. Second, options. According to Investopedia, the definition of an option is a financial derivative that represents a contract sold by one party, which is an option writer, to another party called an option holder. The contract offers the buyer the right but not the obligation to buy or a call option or sell, which is a put option, a security or another financial asset at an agreed upon price, the strike price during a certain period of time or on a specific date, which is the exercise date. Okay, so what are the disadvantages? One, based on taxes and the complexity of it, and it is your responsibility to know this. So the solution actually is to hire a good expert, an accountant who knows about options. Oops, so I went back. 2, commission costs. There are high commission costs when it comes to trading options. So if you're starting out, you don't know the game, part of the commissions, actually when I used to trade options, I need to make at least a minimum of 30% per each trade in order just to average options. So the reason why I'm showing you all this, because I've basically traded every vehicle. It's like going to the buffet, right? When you start out, you go to a buffet or a good restaurant and can give you a good buffet, different type of food. Out of nowhere, you're like, holy moly, where can I start? Which food I'm going to eat? In the trading arena, it's also the same. You don't know which one in order for you to trade as a vehicle. So my goal today is basically, since I've tried every trading vehicle there is, from starting as an options trader and then became a actual scalper in the stock market that used to trade 50 times in one day, and then trading stocks, trading futures, trading Forex. The easiest for me, my own real world, is Forex and futures, and I will explain why. 3, capital. You will need a fair amount of capital if you want to consistently make money in the options market. 4, it's not a good learning process due to its complexity. There are 5 different levels in the options world. When I started learning options, man, by the time you get to level 2, 3, 4, and 5, it gets over your head. As a trader now, where I just want everything nice and simple, I don't need headaches. Options are created for hedging. They've been created within the financial market to hedge their positions. Unfortunately, they made it more of someone made more cool about it. Said, hey, if you trade options, the amount of limitations for you to lose is highly probable. So I think you should learn it, blah blah blah. But there's a lot of complexity into it. So if you don't have the capital to start trading while you're learning, please don't trade options. Also, options can be complicated, especially if you're a beginner. Most beginners and even some advanced investors think they understand when they don't. Okay, next, liquidity and volatility. Options need liquidity and volatility. 6, higher spreads. If options didn't have the liquidity, the spreads are going to be higher. 7 is about the time decay. When buying options, you lose the time value of the options as you hold them. 8, you need a lot of information via the Greeks, the alphas, deltas, and so forth. 9, part of the unlimited risk. So if you're now trading part of level 5, then option positions are buying uncovered options that are accompanied by unlimited risk. Okay, let's go through features. Investibility defines the financial contract obligating the buyer to purchase an asset or the seller to sell an asset such as a physical commodity or a financial instrument at a predetermined future date and price. Futures contract detail the quality and quantity of the underlying asset. They are standardized to facilitate trading on the futures exchange. Some futures contracts may call for physical delivery of the asset, while others are settled in cash. The futures markets are characterized by the ability to use very high leverage relative to stock markets. Disadvantages: 1 is not ideal for long term, or more than 1 year for investors because of contract expiration. 2, the sporadic price movement around major news and market events can wipe out many small accounts. 3, not as many instruments to choose from compared to stocks. 4, margin requirements increases for positions held overnight, forcing many small traders into short-term profits or losses. Okay, the danger of leverage is also for the novice for new to trading. Higher leverage means higher risks. Futures have a leverage from 10 to 1 to 20 to 1. Lastly, it's complicated. Futures contracts are complicated and can be difficult for new traders to understand. Lastly as well, futures is not an ideal vehicle to learn as a learning process because it can be very expensive, especially as a swing trader. The reason for it because margin requirements are expensive. So if you leave your trade overnight, man, it's pretty huge in terms of the margin requirements. Okay. Any questions in terms of stocks, options, or futures before I go to the Forex market? So if so, actually let me unmute all you guys. Do you have any questions for me? Going once, twice, sweet. All right. Why Forex? Forex is short for foreign exchange. It is the market where one currency is traded for another currency. It is one of the largest markets in the world and the least regulated financial markets in the world. It has a daily turnover of around $1.9 trillion compared to the New York Stock Exchange, where it runs around $25 billion a day. It has different trading centers around the world: Sydney, Tokyo, London, Frankfurt, and New York. And what I mean by this, now say once you're retired or you're using this as full-time, and this we used to love before I got settled and got married and just traveling, you are not put into a situation where if you're trading, say, the US stock market, you have to wait until the New York Stock Exchange or the American market has to open. What if you're in Asia? Then you have to wake up a certain time. What if you're in Europe? Then you also have to wake up in a certain time. Now, trading the currency markets, it doesn't matter where you are in the world. Once one market closes, the other market opens. So it's awesome. So in other words, you are not limited in terms of what you're going to trade. Next, it has the ability to profit in both rising and falling markets. 2008, during the financial meltdown, you were limited to not to short the marketplace. In the currency markets, you're not. Yeah, futures is not too. Options are not limited to that as well. 401ks, you can't short. I believe if you're trading 401k, you can't short stocks. But if you're trading currencies, you would be able to. Now, please make sure to double check that with your accountant before, obviously, just opening up an account, right? So just double check with them. But as far as I'm concerned, you're not limited in terms of shorting. 3 is very liquid. Liquidity is very important. Some that I've seen used to trade penny stocks as well. If there's no one buying or selling, then if you're trying to buy, say, 10,000, 50,000 shares on a penny stocks, but no one's willing to give you that, and there's only probably 100 in there, 1,000, then you'll be limited, and plus the spread will increase. The currency markets, you're not going to have that. Even on large cap stocks, sometimes the spreads are also pretty big, right? And sometimes also you need the liquidity in order to get in really quickly. It's highly leveraged. 24-hour access 5 days a week, and I'm going to explain why it is important in terms of that. Okay, here's the deal. If you're working on a 9-to-5 job, if, say, for example, you accidentally left your trade, at least you still will be able to sleep at night, because when you come home, you can still have a look at your trade, and you can choose to close your position if you choose to. Likewise, depending on the way, what type of trader you're going to be, you're also not limited to the time component. What do I mean by this? So say, for example, you're not a morning person. Now, if you're trading stocks or even futures for that matter, or even options, you need to wake up to a certain time in order to catch certain moves. Now, in the currency market, if you're a night owl, then you can trade at night. But if you're a morning person, you also trade in the morning, and you can do whatever you want, right? In terms of 24-hour access 5 days a week. Spreads are very minimal, which is awesome. Not like any type of trading vehicles where if there's no one buying or selling the spread, especially if there's no volatility, the spread will increase. Okay, there are no commission costs. Brokers make money on the spread. So this is one thing I love about it, is that I don't need to pay commissions, or the broker for that matter, because it's free. Brokers make money on the actual spread itself. You also earn interest. It's similar to a dividend. The beauty about it is that dividends, they're all factored in. Well, in the currency markets, they are not factored in. So yes, you can earn interest, but also you can lose interest. But depending on the pair on which one you trade, if you love a certain pair with the highest interest rate, then they will pay you the interest component. But if you're trading a currency pair that has a very low interest component, then unfortunately you have to pay for that interest. But it wouldn't matter anyway. Mainly, you can earn the beauty, or one of the advantages of doing this is that if you leave your trade as a long-term position trend following environment, then you can make extra money on top of your trade whilst it's still sitting there. All right. The flexibility. You can control your risk, and you can trade any time of the day. You are not bound to wake up a particular time to trade. Almost instant fill. When I say instant fill, it is in a microsecond. The faster, if you have a good fast internet, man, they will take you automatically. Sometimes, I don't know whether if you experienced this before, but certain times when I used to trade stocks, when I press enter, and out of nowhere it takes like 30 seconds or sometimes close to a minute before my trade gets executed. And before, when I was a rookie, I didn't realize that people front run your trades. So they will trade first before you. They will look first more in terms of their bigger clients, and then you're pretty much last on the list. But in the currency markets, you're not going to have that problem. You can trade at the comfort of your home anywhere in the world these days. All you need is a laptop, iPad, smartphone, internet. So similar, right? Same with options or trading stocks or trading futures. You can trade anywhere pretty much in the world. So it's great for learning how to trade. You can open up a minimum of $50 account to practice your trading methods in a live trading environment. I always suggest to put in live trades, not demo trades, and the reason for it is the mind, your brain is so smart, it can detect what's real and what's not real. It is similar to sport where I can kick the bag 1,000 times a day, but the bag doesn't kick back. But still, in order to test the strategy, our skill set in a sporting environment, we still need to spar. In the marketplace, it's also the same. This is actually one of the challenges of traders, is that especially if they learn a trading system that they don't trust, they learn it from someone else, or probably they created themselves and it's not working because they can consistently losing money. So rather gaining confidence, they're increasing low self-esteem. So what happens now is that they go to a demo trading environment. In a demo trading environment, the brain goes like, well, it's not my money, I don't care, I'll just put X amount in there. And it starts to work. Then out of nowhere, they go to a live trading environment, it doesn't work anymore, and they start losing money. How many of you in this room have experienced that before? I am one of them, right? So please, now if you're learning how to trade, at least in the currency markets, you can open up $50. I always tell basically part of my students is, well, if you're going to do this more of a full-time environment, open up a $500 account and a micro account, and if you can maintain consistency with that, then we can go put you to the mini account or normal standard account. Worst case scenario, you lose the $50 or $500 as part of your learning. Alrighty, next, it's easy to trade and you can focus with a handful of currency pairs that could make you money consistently. This is the awesome part. There's 6 to 7 major currency pairs against the US dollar. 2 cross pairs. I only focus about 9 to about 10 pairs at a time. In the stock market, you've got a plethora of stocks in there, thousands. You're trading the Dow Jones 30, there's 30 stocks in there. You're trading S&P 500, there's 500 stocks in there. Unless you have a software based on your system that can basically be able to find potential stock trades, it will take you time in order for you to get certain trades, right? Futures, at least you trade a futures index. There's only pretty much a certain only small group as well. You have the E-minis, you have the NQs, you have the Dow, the YMs. And if you're trading the European ones, you have the FTSE, you have the DAX, you have the CAC, the CAC, the French one. Or if you're trading in Australia, then you have the S&P 200, the SPY, right? So, or you can have the Nikkei, which is the Japanese index, or the Hang Seng. So, I mean, you can, there's a handful of them that you can basically trade. So there's a bit about the futures market too. That's why I like trading Forex and futures, because they go hand in hand. Well, the disadvantages of Forex, well, it's at least regulated, but after 2008 and whatever happened, 2009, mid of 2009, 2010, they regulated a little bit, which decreased significantly in terms of the margin requirements. In terms of the leveraging requirements. It is highly leveraged, means high risk, so if you're a novice or inexperienced, it is going to be a challenge too, because if you don't have the skill set, you will lose more of your money basically pretty quickly. So in the US it's 50 to 1. Outside the United States you can get as high as even 500 to 1, but the common ones are 400 to 1, 200 to 1, 100 to 1. Right, and lastly, you can potentially lose your capital fast if you are not experienced. Questions before I go through about the trading hours and going more for like the terminologies used and stuff. Okay, let me unmute everyone. Any questions for me? Nothing? Any questions for me? Okay, great. Nothing then. All right. Trading hours, they're open 24 hours a day, 5 days a week. They have 5 overlapping trading sessions between 5 p.m. Eastern Standard Time on Sunday evening to 5 p.m. Eastern Standard Time Friday evening. Then there's the New York to 8 to 5, Tokyo 7 to 4, Sydney 5 to 2, London 2 a.m. to 12 p.m. And let me show you more in the visual type of environment. So here's the beauty about it, right? So about 7 a.m., 8 a.m. Eastern Standard Time till about 12, there's an overlapping between the London market and the New York market. These are the volatile times. Hence, between 8 and 12, pretty much you're done if you're day trading based on this. Once the New York session closes at 5 o'clock, the Sydney market will open. And then you have an overlapping between Sydney and the Tokyo market. So any pairs like the Aussie against the yen, the Kiwi against the yen, you will see some movement in there. So you can trade whatever you want. You know, you don't even need to sleep if you want to. You can create a system where you can create a team, and one looks after the European session, one looks after the American session, and someone looks at the Asian session. So it's 24 hours. Who was your mentor? Yeah, I have a lot of mentors, by the way, Humberto. When I started, I went through a company called Universal Trading Solutions in the late 1990s, 98. Then I had private mentors. I had one guy, a German-Italian, who migrated from Germany to Australia, won an Australian Stock Exchange trading competition, sorry. And since I love mathematics, I'm a physics and mathematics background, also programming background, that his one was very objective, and up to this day I actually still use it. And yeah, I've seen him trade, and you know, he charged me $1,000 an hour. He came into my house for 5 days to learn his stuff. And then I came here to the U.S., met more professional traders who traded based on the New York Stock Exchange, the CME. And then one guy who I highly respect a lot, he used to trade in a hedge fund as a currency trader. So, you know, one of my methods that I do use are used by these guys, and that is my bread and butter, which I call it method number 1. It's very simple methodology, but can be very complex because there are a lot of things that we really need to think about. So which I'm going to share with you guys as well, and at least to show you what it looks like. Okay, so these are the guys or my mentors, and they weren't cheap. They were very expensive. When I say expensive, very expensive. Okay, next. So part of the overlapping, New York and London between 8 a.m. and 12 noon, Sydney to Tokyo 7 p.m. to 2 a.m., London and Tokyo 2 a.m. to 4 a.m. They're all Eastern Standard Time. Hours where it is most liquid is from 2 a.m. to 1 p.m. Hence, that's why as part of our live trading sessions, we always take the 11 o'clock movement as 11, 12, 1, 2, which is now 2 a.m. So once London starts, boom, you know, you can see some movement, and most of the news starts about 1:30 Pacific Standard Time or 4:30 Eastern Standard Time. 1 p.m. to 5 p.m. is less active. 4:30 to 5 p.m. markets are down. 8:30 p.m. activity starts to pick up due to the Asian market. Okay, so at one point they have to settle, even though they're not really down. What happens is that the spread, they will increase, and they just have to close some of the positions, average some of the positions based on, you know, the bigger banks and so forth. So these are the things that they will, or what the market does, and that's why between 2 and 2:30, I don't really. I mean, I look at the markets, but by 2:30, that's where either I execute to get in pretty much for the next move. All right, currency pairs. There's 7 major currencies against the dollar. You have the yen, the Japanese yen, the euro, the Swiss franc, the British pound, the Canadian dollar, the Australian dollar, the New Zealand dollar, or the Kiwi dollar. And then there's 3 different types of accounts that you need to remember. This is what we call the micro lot, the mini lot, the standard lot. And I will explain to you as well in terms of the learning environment why this is awesome, and it's why I love teaching this. Now, technical analysis, charts is charts. Once you fully understand technical analysis and based on its components, you can trade whatever vehicle you want to trade. But it's in terms of a learning environment with the cheapest, in terms of, you should be investing yourself for an education, and then the money, you shouldn't really be thinking about the money aspect, because the money will come. Once you've practiced a certain skill set and you've mastered that and made it your own, the money will come, and you will basically replicate that from a small account. You replicate it to an average or a bigger account. The process is a process, right? If you can follow the process and you've mastered the process, totally guarantee you the money will come. But if you're just thinking of the money while you're a newbie, or you're trading and you're under pressure, it wouldn't work. You will fail. Okay. Understanding currency pairs. A currency pair is a combination of 2 currencies. So let's take, for example, the euro against the US dollar. Euro is the first currency, also known as the base currency. The USD is the second currency, also known as the quote currency. So the first currency pair is the base currency. The second one, the pair, is the quote currency. So this is pretty much what it looks like. Okay, just give me 1 sec. So here's euro, dollar. See here, and you really, the beauty about this, you don't really need to understand. I'm just trying to explain a little bit, right, in terms of terminologies. But it's already explained. I use FXCM. FXCM is a broker, but it's they're pretty good in terms of liquidity. I've never had any problems in terms of me executing the trade. So you can see here, if you just click buy, boom, you just buy, sell, sell. So there's really nothing to think about. But the first one, the euro against the dollar, so here, the first one is called the base currency, and the second one is the quote currency. So meaning that if you are buying the euro against the dollar, then you're buying at the quote currency of 130.65, right? So okay, let's go. Next one. Any questions? Okay, I don't want to complicate things. So but if you see a buy and sell, just buy order, sell order. Very, very simple. Right. Most active currency pairs are the following: euro dollar, dollar Swiss, pound dollar, dollar yen, Aussie USD, euro yen, pound yen. This too is like driving a Ferrari or even a Formula One car. So always tell traders who trade the currencies, or students, that if you can't handle the speed, don't drive it. So these are the 2 ones, because they are very, very fast. You can make 200 pips in less than 10 minutes sometimes. Like say yesterday, it was awesome. Okay, just 1 second. Let me see if I could be able to show one to you as an example. Okay, see this movement from the opening price at 125 all the way to the low at 118. It closed at 119. That is a 600 to 700 pip drop, meaning that 1 pip is similar to 1 ticket, equivalent to $10. So if you have a normal standard lot, you would have made 5 grand basically in 1 day. This was a few days ago. So imagine if you have 3 normal standard lots, to make $15,000 pretty much in one day is awesome. I mean, which business could be able to give you that? Nowhere. Can stocks give you that? Yes, it can, but you have a big amount. You need to have a bigger capital. Options, can it give you that? Yes, it can, but you also have a bigger capital. Can futures give you that? Yes, it can, but you also need to have a bigger capital. Right? But if you don't know what you're doing, this can wipe you out pretty much in an instant. So the euro yen is very volatile. The pound yen, very, very volatile. The pound yen was approximately from 142 all the way to 137. 500 pips to the downside. So now from the current high 147 all the way to 139, let's even make 140, 700 pips to the downside. 38, 900 pips, almost close to 1,000 pips as of the mid of February. So 1,000 pips, that's $10,000 basically just for one normal standard lot. Okay, so yeah, they are very, very, very volatile. Okay, any questions so far? Nothing. All right. Let's go through buying and selling currency pairs. All Forex trades involve simultaneous buying of one currency and selling of another. So if you buy a currency pair, you're buying the base currency and you're selling the quote currency. The bid price is the buy price. The ask price is also known as the sell price. The bid price represents how much of the quote currency is needed for you to get 1 unit of the base currency. Okay, just 1 second. Let me put it back here. So if we're buying the euro against the dollar, it will cost you 1.3066 euros for 1 US dollar. Okay, that's what it represents. Alrighty. Conversely, when you sell the currency pair, you sell the base currency and receive the quote currency. So the ask of the sell price for the currency pair represents how much you will get in the quote currency for selling 1 unit of base currency. Okay, let's go through understanding pips. Pip is what we call a price interest point. It's equivalent to a tick value for futures and equities. For example, in Euro USD, if it increases from 137.04 to 138.04, it means that you've made 100 pips, or being 0.0100. So since they're in decimal points, and then in actual fact they put another 5th decimal, but we just ignore the 5th decimal to make things easier, it is basically 100th of that decimal point, hence to make 100 pips. Alright. You can also use a pip calculator by going to a website. Actually, there's some resources that for members as well in order to create those, find out those calculations. Leverage. Leverage is when your invested cash you use to buy or sell foreign currencies that are worth far more than your investment. In other words, leverage gets you more currency than you pay for. Prior to being open to the public, the reason why banks, it used to be currency trading was only meant to be for banks, because if there's no leveraging component, one contract will cost $100,000. Remember, not everyone will have $100,000. So in order to be available to the public, to the retail traders like you and I, they need to put a leverage type of system in order to make it cheaper for everybody, so everybody will be able to have the same ability like what the banks do in terms of trading the currency market, right? Okay, now that's why traders now can receive from 50 to 1, 100 to 1, and 400 to 1. So in the US, by law, the maximum you can get is 50 to 1. But other than that, anywhere in the world, you can get as high as 400, sometimes even 500 to 1. Okay, so leverage can increase profit potential and also losses. So for example, if you have a $10,000 account, which you opened a Forex account, so if you have a 50 to 1 leverage, then your buying power is $500,000. If you have 100 to 1, then your buying power is $1 million. Part of that is also margins. There's a certain margin requirements that each and every broker will have. FXCM, for that matter, has 2%. Margin can be thought of as a good faith deposit required maintaining open positions. It is not a fee or transaction cost. It is simply a portion of your account equity set aside and allocated as a margin deposit. In other words, you won't be able to lose any of your money, or you owing the broker. This is to actually protect you as a currency trader. So say, for example, you're trading euro dollar and you bought one contract. Since the 50 to 1, your total layout will be around $2,000, $3,000. Now, if you didn't put a stop loss and just left it and you went for a holiday and it tanked, when it comes down, once your account goes to about $2,000 or $3,000, they will liquidate you and they will close pretty much your trade. So you won't go below the zero watermark. Does that make sense to everyone? Alright, good. Alright, this protects you from losing everything in your account to go negative. Alright, different brokers give different margins. FXCM give 2%. So there's 3 different types of accounts, what we call the standard lot account, mini lot account, and the micro lot, 100,000, 10,000, 1,000. So how does leverage and margin use with standard, mini, and micro? So if the broker offers 2% margin, if you have a standard account, a mini account, a micro account, if you're buying one, say of the euro against the dollar, then it will cost you $2,000. On a mini, it only costs you $200. On a micro, it will only cost you $20. Hence, that's why I love teaching the Forex market, because of this component. So, account example, say you open up a $10,000 account and you have a leverage of 50 to 1 with 2% margin. Each time you buy one standard account, so if I show it to you briefly, so say for example you want to buy you're going to say buy 100,000, then for the euro against the dollar it will cost you 3,000. Which one that cost only 2,000? I believe the Aussie against the US, actually they increase the margin requirements, 2,400, 2,400 if you're now buying the Aussie against the US dollar. So each pair differ in terms of the margin requirement in the currency markets. Okay, going back through this example. So your total outlay per se, say 2,000. So if you buy one standard lot of euro USD at 137.10, 2 days later, the same currency pair went to 38.10. You sold it, you made 100 pips, then your profit is $1,000. Every pip is $10. Then your ROI, which is now your return on investment, is 50%, which is awesome when it comes to a leveraged component. To make 50%, the stock market, it is a bit of a challenge unless if you have a leveraged type of trading account. But if you're buying, say, HP, at how much did it go? Let's say, I think 70, no, 30. Okay, let's take Apple. I don't know the price of HP. Apple is about $450 per one share. If you're buying 1,000 of those, then you need 450 grand, right? But if it goes 1,000, if it goes $2, then you made 2,000. If it goes 10, you made 10,000. But if you divide that by the amount of what you put in, there's no way you can make 50% based on return on investment. Say if you get made 4,000 based on a 450,000, then you only made 0.01%, which is still not bad. Well, actually 1%, which is still not bad, right? Okay, so let's move on. However, now if it dropped 100 pips, then you lost 1,000, then you lost 10,000. Sorry, 10% of your account, right? 1,000 out of 10,000 is 10%. Now to go through a mini account, where now a mini is about $200. So if you made 100 pips, you made still 50%. 50% is 50%. It's all relative, right? profit is $100. However, now if you lost 100 pips, then it decreases quite a lot. You only lost 1%. On a micro account, it will only cost you $20 per one. ROI remains the same, 50%, because each and every pip is 10 cents. Yes, it cost you 20 bucks. You made $10, so it's still a 50% ROI. Then you only lost 0.1% of your account. Therefore, in a learning environment, this is what I love to teach, because if say your success rate is 50-50, then you'll be in the game for a very long time. But if your risk or your win to lose rate is 50-50 and you're normally trading a standard account, by the time you have a 10,000 account and it's a 50-50 chance that you're winning, then your 10,000 will be down straight to 5,000 straight away, right? So yeah, and this is how a lot of traders who trade in the currency market lose they lose all of their capital because of that component. All right, any questions in terms of that? Now, do you see now the value of that in terms of learning environment? Hence why the Forex market is getting popular at the moment in terms of trading, because of this component. Obviously, not everyone will open a micro account, because some of them will have basically the attitude saying only 10 cents, then that means that I can only make like $1, $2. You see, that's the wrong way of thinking, because if they're new, they really should be thinking about the dollar component. They tend to forget about the return on investment component. That is more powerful than the money aspect, because their goal is meant to be just be learning, right? If they're new to the game, not trying to beat the big guy straight away without having the proper experience or the skill set. All right, let's talk about rollover. Okay, sorry. Do you have a rule for how much to risk on one trade in or a set of trades? Absolutely, Steven. I will show you my trading checklist. We have 1%, 2%, 3%, maximum 6%. If I use method 2, and I know it's a highly probable, even method 1, sometimes I can go my maximum is 10%. But I always teach traders use with the 1% or the 3% rule. Before, the maximum that we use is about 3% or 5%, but because of the decrease of leverage from 400 to 1, 200 to 1, even 100 to 1, down to 50 to 1, hence is why we increased it to a maximum of 6% per trade, right? Yes, don't worry, Tony, you're going to see that pretty shortly. So what I'm just trying to achieve here, just please be patient. We're trying to show here are the most important aspects actually, but later I will show you some tips on the trade. I'm going to show you part of the way how I trade too, and I'm going to give you one trading methodology that you can actually use. I have 3 different methods. I wish we could have more time, but this one is actually pretty easy. All right, so if the interest rate, the rollover, a unique feature of the currency market is that currencies allow you to earn profit or interest in addition to earning from the capital appreciation of the currency. When trading the spot FX market, it is not a derivative being traded as it is with a futures contract. It is the actual underlying instrument on what you're trading. Accordingly, as each currency has an interest rate associated with it, each position is debited or credited when rolled over. For example, I'll give you an example. So I say you're buying the euro against the US dollar. You're buying the euro, and at the moment I believe it is not 4%. This is just a theoretical, hypothetical example. So if the euro interest rate is 4% and the US rate is 2.25, I know that the US interest rate is 0.25, or actually less than 1%. You're buying the currency with a higher interest rate, and you will earn rollover about 1.75, that's 4% minus 2.25, on an annual basis. So if you sell the euro-dollar pair, you are selling the currency with a lower interest rate, and you will pay rollover. over 1.75% on an annual basis, since you are paying the euro interest rate and earning the US interest rate. If you're trading the Aussie against the US dollar, hence that's why I like trading the Aussie, I like trading the Kiwi, because of the interest component. They're huge. Aussie is around approximately 5 to 6%, Kiwi is about 6 to 7%. And so if you're leaving your trade over there, you gain interest. Now the trick to it as well is there's a trick when it comes to this. This is awesome. So 5 p.m. in New York is considered the beginning and end of a Forex trading day. Any positions that are open at 5 p.m. sharp are considered to be held overnight and are subject to rollover. A position open at 5:01 p.m. is not subject to rollover until the next day, while a position open at 4:59 p.m. is subject to rollover at 5 p.m. Hence, that's why I like looking at markets. My trading time has been 2 to 3 p.m. Pacific Standard Time. That is my time. I already get into my computer screen at approximately about 1:45 in the afternoon. So I scan the 7 majors and 2 cross pairs if there is anything. As long as I execute prior to 5 p.m. and there is a really good trade right there, I will enter. I will get the interest component of that trade an hour after I executed the trade. It's actually awesome. So our credit or debit for each position open at 5 p.m. appears on your account within an hour and is applied directly to your account's balance. Some methods or some of my trading strategies basically is an overnight swing trade, hence because I just want to create a part of the interest component too. Wednesday is what we call a double payday, because the market closes on a Friday, and technically speaking it's closed, they're closed 2 days, but Saturday, and when it opens at Sunday, they have to include the days that they were closed, hence is why they call it a double payday. So Wednesdays are awesome to trade, which I will actually show you. So nobody's going to go through this. So how to be a profitable consistent Forex trader? Once, I'll give you some tips on what to look for and how to be a profitable trader. Looking at the best days of the week to trade Forex. Tuesdays and Wednesdays are actually the best. The pound dollar, the dollar Swiss, I know in terms of the amount of pips that it's increased a little bit because of the volatility aspect. I'm sorry, there's a question here by Share. Does the time EST apply to other exchanges such as London? Yes. The US contributes about close to 70% of the whole global economy, and the dollar is still the powerhouse, whether we like it or not. So everything will be followed by US Standard Time. So everything will be the Eastern Standard Time component. So if you are, say, in London and you're trading in London, then they have to follow EST time. Asia, same. But obviously, each market have their own time zones and their own trading centers. So when the US market closes and then the Asian market will open, then it's going to go via now the Asian time. And then the Asian market closes and then the European market will open. It will go via the European time. And then it will go open again the American time. So it will apply within their own time zones when the market opens within them. But if you're trading any pair against the US dollar, then you have to follow the time here in the US. So I hope that answers your question. All right, Sundays, that's why I don't look at Sundays, because it is not that volatile, with the exception like over the weekend when there were reports, the Italian parliamentary election. That's when there was a big gap in the marketplace. But I love trading actually gaps, because the gaps will always be filled in, and that's why me and some of the students actually made pretty good money because of the gap, and it tanked, right? And it kept tanking. So yeah, it's awesome. So anyway, Tuesdays, Wednesdays are the best times of trading. Thursday is not too bad. Monday, we look at the marketplace just to see if there's any potential ones, but by Tuesday or Wednesday, boom. So if you're a day trader, actually, those are the good ones to trade Tuesday and Wednesdays because of the amount of pips that you'll be able to attain. Some, I've seen different trading systems, pretty crazy actually. I've seen some traders that are just happy of making 10 pips. Some traders are just happy of making even 5 pips. But they do make a big difference. 10 pips make a big difference if you're, say, putting 300 lots in there, meaning $3 million dollars worth that you're putting in. That's pretty much leverage. Because if you're getting 300 times 10 and you're making 10 pips on 300 lots, you're approximately making about $3,000, and to go 10 pips in a minute or less, is achievable. Okay, know what type of trader you want to be: momentum trader, day trader, swing trader, position trader, trend follower, a mechanical trader, a discretional trader. So if you don't know, email me and we can discuss on how we'll be able to find out on how you'll be able to find out in terms of what type of trader you want to be. The reason why it's important is this. If you go to forexfornews.com, I took this actually from their site, and hence I am also stating where it got it from. Based on the profitability by time frame, if you are trading less than, say, here is the 1 minute chart, your profitability is very, very slim. At the same time, the probability that you're not going to make any money is actually pretty high. Sorry, I was just trying to find for the actual word I'm looking for. So if you can see through here, a profitability score of 5 means traders are on average breaking even. Below 5 means losing on average, and above means profiting on average. By the time you hit the 1 hour, you're in a break-even mode. But if you're trading on a 4-hourly chart, a daily chart, or the weekly chart, then the probability of you making money in the marketplace is highly probable. Hence, that's why when I'm teaching, I only go out to as low as a 1 hour chart. Sometimes on a live trading environment, we do trade the news, and we can go as low as the 5 minutes, and we can just make 14, 15 pips, pretty much just like that, pretty quickly. Sometimes we just leave it there and we put mechanical orders. I'll just show you actually. Oh no, I didn't save it last night. Bummer, but I'll show you an example. Just remind me later. So the lesser I trade, actually, to be honest, in the currency markets, the more money I do make and the more pips. On average, we make close to about 1,000 pips pretty much a month. Okay, that's pretty much on average. 600, 400, when I say minimum 1,000, these are per contract. Obviously, if what you see online, where, okay, now what you see online here, where it's now say January, it's 642 pips. This is only based on one contract. So if we do 3 contracts, then that's what I would say is a minimum of about 1,000 pips. February, there's really nothing much in February because we look at the timing. Timing is very important to us. So actually, I'm going to need to update this because we had one losing trade actually last week. We had 2 wins, 1 loss. So the winning in terms of statistics is actually very high, right? And you can see based on the methodology. And 653 pips, but because of what we did based on the euro yen, the pound yen, that should be boosted close to more than about 1,000 pips actually, even if I include that 1 loss. Right, so but in terms of what you see based on this is actually very important. It's an important component. And lucky, actually, when I found this out, I'm glad that they did this experiment too. So this is based on 400 traders. And it's very true. I highly believe it too. This is the same when it comes to day trading and also in futures trading. But unfortunately, in the futures market, basically, if you're trading the futures index, yeah, it is a bit tough if you leave your trade overnight because of the margin requirement. All right, let's move on. Next one. 3. When learning, it is imperative to practice, practice, practice. You need to execute live trades, not demo trades. I believe in demo trading, but demo trading, in my own personal opinion, is just for you to be familiar with your platform. But if you're already familiar with the platform, you need to put live trades in there because there's a big difference between emotionality of a demo trading component compared to a live trading environment. Attend live trading classes. Obviously, if you don't have that availability, I mean, we do have that component, but of course, it's not for free. You guys can come in, no problem, but based on subscription based. I highly recommend that because the more you come in, you can see more people coming in too, or the way they explain or the way they do their trades, and also the way how the teachers actually explain the system. So if you're learning a system from someone else, ask them if they have a live trading environment, because that's the only way for you to learn from someone who created the system. When you're seeing a trading system that you've learned, it should be applied in real time, not in static, right? Because the market is dynamic, and this is what causes every trader the fear, all the negative emotions, anger, is because of the uncertainty of events. We don't know what the future will bring us, similar to what happened in the marketplace. I mean, I totally guarantee people were still buying at the level of supply a few days ago, and all of a sudden, bam, it tanked. So people who bought at the top, they all got stopped out. So they took everybody out on the bottom, and all of a sudden it went back up today. So imagine now the irritability, the anger, the frustration that trader faces, right? Always have a competitive mindset, meaning that I don't mean in terms of competition or being competitive with the marketplace. I'm talking here about yourself, so you can go to the next level each and every time that you do trade. Always be competitive. Right, 4. Look at the based on this in terms of the retention rate. That's why if you're just learning how to trade on a lecture environment and you're reading, this is the amount of retention rate you're receiving. So if you go to a discussion group, actually a few people inspired me to create, I call it now the Trader Dojo, which may come in the office, which will start in March. So as part of that, because this is what I do on my private clients, but not everybody would be able to afford my services, unfortunately. So a couple of them basically inspired me, said, how could I still be able to do it, help them, and charge them not that high, but at least something that can, that's also worth for my time. Because here, as part of retention rate, is very important. Discussion through discussion group, practice by doing, and teaching others immediate use. Hence, that's why the success of my students making money in the first 3 months is very, very high, is because of the way on how we do things in the learning environment. So teaching others immediate use is also very important, right? Okay, next, the best traders don't always win, but those that trade the best most always do. I love Lou Holtz, so I took his phrase and just basically changed it to the best players don't always win, but those that play the best most always do. So I just changed the word players to traders. Alrighty. It is important for us to know the macro fundamentals of the global economy and how everything is all connected. I don't just focus on the technical analysis perspective. I say this is because price is based on news. And where is this news coming from? The news is coming from the macro fundamental things of the global economy. I will continue to show you guys later, but I'm just going to explain that very briefly. Macro fundamentals like say what Bernanke did, right? We're being aware of that for this week. PPI, housing price index, unemployment rate, GDP, which is going to be actually reporting Thursday for the GDP. So each in every country will have their GDP reporting. So they will affect a certain price, and if the news is really bad, then there's going to be a lot of fear, which creates a lot of supply. Less demand, price will drop, and vice versa. That's why news or information is very, very important. All right, next, have a good step-by-step methodology and a good trading checklist. I will share with you my trading checklist in a minute. 5, actually part of that in terms of methodology, you should be able to create a methodology for you all, on your own ability in order for you to be very confident in the way how you do trade. This is my methodology. This is my structure. I believe that first you need to have a certain mindset. Part of your awareness, you need to be aware each time you trade. And how can we be aware? Is by having a good trading checklist. Part of your state of mind, if you're being positive, you're negative, and you have negative value system, it wouldn't work. Because how can you dictate to yourself is saying, I'm a successful trader, but you're feeling fear, and that your value system is that you have a fear of execution? It wouldn't work. Then that means you're just lying to yourself. So in other words, if you're saying to yourself, I am a consistent profitable trader, I am feeling happy, I'm feeling calm, I'm feeling focused, and that part of my values and belief system is that I am the best trader in the world that make money consistently in any market conditions, then you're dictating based on who you are as a trader. Then part of that, you follow your action steps. These are my 5 simple action steps that I do in terms of the market. The money, I don't even look at the money aspect. If I could follow this, whatever outcome it's going to be, then that should be the end result. Money should come. This will be the process. If you do the process right, man, this is how you can maintain consistency in the marketplace. 5, you need to have a good trading system that you can trust. When you have trust, you will have the confidence. When you have the confidence, you will execute without fear, guaranteed. There's a great book which I do like. It's called Winning Forever, actually, by Pete Carroll. Pete Carroll is the coach for the Seattle Seahawks. I believe he used to be for a very long time the football coach for USC. So basically he stated one of the keys to success lies in knowing and believing in yourself. When you are confident and you trust in who you are, you can perform to the best of your ability. Whether you are coaching the USC Trojans or the Seattle Seahawks, working at your job or running a household, all you should ever strive for is to be the best you can be. And that is the essence of what it means to win forever. Absolutely. Totally agree with him 110%. Alrighty, let's go through and show you a trading methodology. Okay, as part of that, give you a bonus, a simple trading system that has a high probability of winning consistently, and I call the SMS pattern recognition method. Probably a couple of you guys have seen this before, but if you haven't, please hang around. If you gotta leave, that's fine. Totally understand, since it's getting too late too. In actual fact, now I still have 40 minutes of the webinar. Okay, just bear with me for 1 second. Let me explain the methodology very briefly. All right. There's just 3 simple steps on how to use method 3. I call it method number 2 because each in trading system, they have hierarchy. Oscillators come second as an indicator with a certain price reversal pattern. And then moving averages, they too come last in terms of a trading system hierarchy. Because moving average is simply an average from a closing price point for the past X amount of days. It is a 50-50 component. So in other words, in a supply and demand component, it is the equilibrium between supply and demand, right, from a basic economic point of view. All right, here we go. So going long. So the first candle has to be bearish. It has to be a bearish candle. And notice through here how the upper and lower shadows is not twice the size of the body of the candle. As long as the shadow is not longer than the body, then that should be fine according to candlesticks description. Okay. Okay, the second candle, it has to be an indecision candle. Indecision candles are any types of dojis and spinning tops. This means that the bulls and the bears are undecided whether to go up or down. Technically speaking, yeah, I do have a protocol, the Art and Science of Technical Analysis, on how patterns are really being formed. So when something is bearish, and how can we define when something is bearish based on supply and demand? It means that there are more sellers than buyers. When there are more sellers than buyers, the price will drop. How did the price drop? It's all based on news. Once again, it's all based on fear. And then, when an indecision bar will happen, that means that part of the indecision process, the price have stabilized itself because they're not too sure whether if the price can continue to drop even further, especially on the level of demand, or is there now an opportunity for the price to reverse? Hence, that's why the bulls and the bears are going to fight. It's an indecision. It's an uncertainty. They don't know where to go from there. Now, on the third bar, when there's an indecision bar, the price, see through on that side, oops, let me come back up for a second. The third bar, when it's bullish, it means that now that there's a part of it that there is a probability that the price will reverse to the upside, meaning that the trend to the downside has ended to a certain degree, that the price can reverse to correct itself. The market cannot okay, sorry, will you be recording it, please, as missed the start? Yes, it is currently being recorded, Erica. Yeah, no problem. The price cannot just drop like there's no tomorrow. Okay, here's an example. I will show you what I mean by it. Okay, let me delete something. Oh, here we go. Let's take the pound against the yen. Remember, a chart is a chart once again. This could be Apple, this could be RIM, this could be gold, this could be silver, this could be anything. The price cannot just go to the upside in a straight line. They have to stabilize itself and they have to correct itself. So dojis are stabilization points. Once the market has stabilized, it's either they will correct or it will continue the movement to the upside or go to the sideways movement. Hence the three scenarios of trading, up, down, or sideways. But how do we also know that if the market has topped out or run out of gas? Well, they have certain conditions. So say, for example, from this point, somewhere based in the past, they have to touch certain areas. So like here, there is a consolidation around that area, this area, this area. So there is some form of evidence that that price point might be a price where the price can just halt to a certain degree. Well, the last one that's really, really strong is at this price. The other one was at this price. So when I'm making things in terms of objective, I always look and focus at the high and the lows, because the lows are being supported by institutions, the highs are being also resisted by institutions. So they're the big guys, the big players. Okay, notice from this price point where once it reaches a certain good level of supply and the price is currently, if you can see through there, it's running out of steam, right? It is by law that the price has to correct itself. And how also do we find out by certain, up to where can it correct? That's no problem. Hence, that's why those fibs are also an important component because it can also help us dictate up to where the price is going to retrace. From the current high, from the last lowest point of the low, notice part of the 38.2, it has to correct itself at this level at 39.43. From that, so if you're shorting at a level supply where your risk is so small and your probability of winning is highly probable, then you would have made close to 900 pips pretty much to the downside. That is part of our methodology that we use. I actually use a method number one because they go in hierarchy. So as part of this example, the price cannot go to a certain level. They have to correct itself. Price patterns like evening stars and morning stars and what we're showing you here, they do the same. They have to correct itself, and hence where am I? Oops. There we are. So once there's a lot of momentum, it has to stabilize itself before it can correct itself to a certain point. Hence, morning stars. That is the whole purpose of a morning star. Alrighty. Alright, the next step is that you need to identify and define areas of demand and supply. Areas of demand and supply are very, very important when it comes to trading because these are your price points of where institutions are holding prices and or resisting prices. So if you see a morning star pattern, this is a reversal pattern. Right? It got exhausted, it reached the demand level. Here's a morning star. The odds and probability that this is going to go to the upside is highly probable. However, if you notice here, it's still pretty much on the downtrend. The trend is your friend, but on this price point here, it's also an uptrend. So if it is on a level of demand and it's an uptrend and you see this pattern, that is an awesome sign. Right, so that's the number 4 part component. Okay, next is I'm going to give you a oscillator of the fast stochastics. 10 in the 3. Please don't ask me why 10 in the 3. These are what professionals actually do use. Every currency doesn't just happen in either a based on the closing price in terms of the overbought or oversold. For some reason, it is just a magic number. So I paid a lot of money in order to get this information, but this actually work all the time, especially when things are done correctly. Alright, so it is a 10 and 3 fast stochastics. All indicators are all lagging indicators. Fast stochastics is just a little bit more faster in terms of the speed component of it. But at the end of the day, based on the closing price, it is still pretty slow, right? Because they're all lagging. So the middle section or the doji or some sort has to be in below the 20% mark, because oscillators that RSI, stochastics, either the fast, the slow, CCI and so forth, they are all cousins. RSI or fast stochastics for that matter. I just use the fast stochastics because this is what I learned and this is what works. If it's on the 20% level or below, it means it's oversold, and that means that the odds and probability that more buyers will have to come in is highly probable. If now, which is on the next one, there's a certain calculation that is so important. Looking at the entry price. Okay, that's step number 1. We're going to go to step number 2. We need to find the entry price. How to find the trigger price to enter? The trigger is the price we need to find to execute to enter. It has to be a specific number. There's a certain rule that we need to do. So we need to look at the first candle of the morning star, do the simple calculation, the open price plus the close price divided that by 2, that is your trigger price. So in other words, this is what it looks like. Okay. Here's the first bar, first the candle. We have the opening price, you have the closing price, and the trigger formula is the opening price plus the closing price divided by 2. 129.065 plus 128.12 divided by 2, 128.59. That is the trigger. Okay. And now if we look at the third bar, the third candle, if the closing price is equal or greater than the trigger price, then you need to execute without hesitation. The probability of you winning is very, very high. When I say very, very high, about 80 to 90%. Obviously, there's certain tips as well, the flaws of method number 2. But we'll take actually at least a whole day just to explain it on how it's worked. Right, step 3, we're going to find the stop loss and the target point. So how to determine the stop loss? The stop loss is determined by the lowest price of the 3 candles. So here's the low of bar 1, there's a low of bar number 2, the low of bar number 3. So we're going to take the lowest out of the whole 3, which is the second bar at 127.08. It is evident that low 2 is the lowest out of the 3 candles, so we're going to take this as the stop loss. We have different options because not everybody as a trader will have the same amount of risk. Someone who is more risk averse, then you need to just reduce the amount of spread based on the pair. So 127.08 minus 4 pips, 127.04 is your stop loss. Someone who can handle a little bit more of a bigger risk, then you take 10% of 127.085, then your stop loss is 126.95, right? So there are 2 different stop losses. Okay, just to make it for objective, what I tend to do is I just use the low minus the spread, because in most cases anyway, the price wouldn't drop to that price point. The reason why we need to take the lowest low is because each and every low of each bar are being supported by institutions. Not you and me, not you and I, you're not retail traders. These are going to be institutions. So if the price has been broken, you're done. That means a continuation of the trend will continue. This is going to be your stop loss. It is imperative to have that stop loss. Now, the position size is being dictated by the amount of risk you're willing to take. So for example, if you're only willing to risk $200 and the calculation will give you, okay, for you to risk $200 from the current market price to the stop, I can only give you 1 position size, right, or 2 position size. So it all depends on the amount of risk you're willing to take. This is also the calculation based on the amount of capital you have. So say for example, if you have a $100,000 account, you're only willing to risk 3% of the account. 3% of 100,000 is $3,000. Then you can play part of the $3,000 your calculation, or you should have a position size calculator that would calculate from $3,000 and the difference from the entry about 128.70 to 127.06. That's about 160 pips. That's about 1,600 loss. So I can play 2 standard lots. That's how risk management and money management should be played, right? Okay, and now let's go through what it did look like. Part now is we need to determine target points. Since morning stars are reversal patterns after a downtrend, price has to retrace itself to the upside. Therefore, in order for us to be very objective, we are going to use Fibonacci retracements. They are very powerful because they dictate approximately, I say approximately, that Fibonacci doesn't designate the actual real number or when the price goes into there. To those numbers, it's just an approximation of where it can lead to. Alrighty, those are the target points on what we use. So, for example, You can see here from, because this is the last high, this is the current low, that's the last high. It is no longer valid because all three has been taken. And then we need to find where is the next high. This is the next high. So we can see here part of that. T1 is very close. In terms of a probability aspect, the 50%, 128, 65, it's done, right? So the next highest probability, 99.9999999% that you will make money is a 129.02. The next one is not the high of that. This is your target number 2. Target number 3 will be the last high. However, there are certain elements as well that you can't be greedy. So when we put our target points, if say the 62 or the 62 is the highest it's ever been, then the next one you see here, there's the next low, that's the next high, that's the next high. I go on average approximately around here, about the 130, in order just for us to be taken. When price go to or reverses to the upside, to the downside, you will be able to see here that as part of that, in terms of probabilities, what is the highest probability? The shorter it gets, the price closer, the probability is higher. Once the price goes away, then the probability decreases. So you need to find, in terms of a target point, if the probability is so high, won't you take part of that? Absolutely. Hence, as part of the target profit maximizing strategies we use, either 1/3, 1/3, 1/3, 2/3, 1/3. If the market or this particular pair, for example, it's a downtrend, it's a reversal, I will take 2/3 because I'm going against the trend. If that makes sense. But if it's an uptrend, then I will only take 1/3 because I am with the trend. So it all depends as well on the trend component. All right, let's go through and let's move on. Okay. And here's another example. This is the highs of the move of the actual swing itself. Hence, swing trading is defined as a swing trader. You are catching the swing of the trend. So when there is a downtrend, lower lows, the next one will be lower highs, lower lows. Part of that lower high component, remember, when we as professional traders, this is where we need to analyze is what the probability of the future will bring us, not here in the past. The past is done. The past will only give us some form of evidence to support our analysis for the future. That's what should be, technical analysis should be. Oh, hi Charles. Yeah, no problem. Thank you for coming. Okay, so here, the 38.2 was also 62%. This is what we call the confluence of Fibonacci's, right? Where it is not the specific, there would be the range of where the numbers are going to be. So 129.43 to go to 129.43, the odds and probability by about 99.9999% it's going to go is highly probable. 50%, the probability will decrease by at least 10%. So meaning it's no longer 99.99, it will be about 80%. 60%, it will decrease by another 10%, probably 70%. Because in order for the market or the price to come back up, it needs a lot of confidence, a lot of optimism why the price should really go back to 132, especially on a downtrending market. All right, does it make sense? Questions? Nothing. Sorry guys, and if you sometimes I can't see your questions because I just love this stuff so much. All right, it's just basically exciting. Okay. Okay, here we go. So now as part of that, on that component, right, we're seeing the whole picture. Step number 1, we saw the pattern. Yes, there is a morning star pattern. It's in the level of demand. Stochastics on the oversold. Here's the trigger price. We have the entry. We have our stop loss. 127.04 minus the spread. We create our target points based on retracements because we're based on probabilities. T1, T2, T3. T1, 129.43, 130.16, 130.88. Okay, so it took 2 days to reach all profit targets. From a point of entry, 1, 2. Third day went beyond. See how, in terms here, just to show to you guys that by the time it reaches the 62, the probability will start to decrease. Once again, because it needs some form of optimism. Give me some proof. You know, that's what the market is saying. If you're a buyer, say in a real estate market, if in the past it's a downtrending market and people are selling, are you going to buy a property that's worth $133,000 if it's not really worth $133,000? No, you're not. Right? You're not going to buy it because it's too expensive. Hence, this is where I don't understand with some traders, because when they get to the 133, they're still buying it. Low level supply and a downtrending. That's why they don't make any money, is because there are retail traders buying at supply rather than selling at supply. They're done. It is finished. All right, next. Let me go through. Let's show you guys some real examples. And also I'm going to show you as well part of my checklist. Okay, so everything is basically documented in terms of the way basically I do trades. Here are my template, everything all are in there. Okay, I will take one against the pound, against the yen on M2. So here's a trading checklist based on from what you saw earlier on the B2Have trading model, right? See here we have an entry date, an exit date. There's the pair. See part of who I am. I'm an aligned super trader that profits consistently in any market condition. How do I feel? I feel calm, feel focused and confident. Values and beliefs. Highest values, integrity. I believe I'm the best trader in the world. Before, I'm calm, confident. During, I'm calm and patient. After, happy. Then I look at the macro fundamentals. We look at the dollar index. The dollar index is one of the best indicators that you can use, and this works very well in stocks, futures, and forex because they go all together. It's like, it's like a chain. They're all connected. Then the news. I'm going to need to be aware that it's going to be a euro news all day. The markets, Dow is bullish and hovering around 14,000. Try to correct, but it's in current consolidation. Trading strategies, a day trade. And the pattern is our methodology. Method number 2. Do we analyze top down? Yes. What is the trend? It's an uptrend from a lower high. It's in a level demand of supplies and supply. Our bears are currently in control. I'm going to go short despite being an uptrend. So I'm going against the trend just to catch that movement to the downside because maybe perhaps there is a methodology based on M2. Time frame is a daily. Triggers the market price. Enters 147.40. Risk management 3%. Stop loss 148.05. Are you willing to lose the amount and take full responsibility? This is one of the most important questions that you should have in your trading checklist. Because if you say yes, then you can move on to the next one. If you don't, you'll be in trouble because the regret happens. All the negative emotions will happen. Profit target, 146.63. Okay, so here we go. So I also look at, I need to catch a screen, so I save it, and then I basically post it. See from here, here's a signal based to go short based on the methodology. Since I didn't get into the closing price, I actually got in on the next bar. What I tend to do is I need to wait sometimes almost close to the T of the time. So meaning that if it's now 4:48, I'm going to wait until if it's 4:59. Where is the price going to be, especially if it's getting close to the trigger? Because even by 0.0001 of a pip can sometimes fail. Why? Because the reversals, especially in an uptrend, this could just be a correction before a continuation to the upside. So notice how the price went up and then went down, and the beauty about being mechanical is that I don't care if the price goes through there, I got my stop. And so in terms of the target of 146.63, 146, see, actually even through there is 77. I got it at 63, a bit lower. These were a perfect trade based on M2, a 77 pip gain, rated out of myself out of 10. So there's an example. Okay, now Tony asked me, so can you show me the way how you do stuff? Okay, no problem. All right, let me go back. And there's a certain process that I always do. Just 5 simple steps. One is I need to look at the macro fundamentals. So these are basically for private clients, because I want to make them for them to be trained methodologically in a certain process. So step 1, we look at the macro fundamentals. So what are the news that's bound to happen? Okay, I need to find that out. So at this point, okay, let me refresh it actually, just see what it will be the next timestamp on when the next one is going to happen in terms of the news. Okay, so in 2 hours and 9 minutes, then we have the gross domestic product, but they're all low impact. The next one is in 6 hours and 9 minutes, the U.S. consumption indicator. Then there's also another one, GFK, consumer confidence. Meaning now then that if we're trading the euro, and this is actually Hong Kong, so I don't really trade the Hong Kong dollar. But if we're trading the pound in 6 hours, 9 minutes, you need to be aware that there's some form of reporting. And the other one is we use as part of the source is Forex Factory. Need to find out where is the next and upcoming one. So there is really nothing except for that consumer confidence or consumer climate. It's also medium impact. Also medium impact stayed over there. So about 11 o'clock, 11 p.m. when we start doing the live trading class later on, we're going to be aware that the euro is going to be very volatile. It could move the movement, and perhaps we could even trade it depending on what the group will dictate, right? And then 4:30, we have the second estimate of GDP. We have the Italian 10-year bond, core durable goods. We see Bernanke is going to talk tomorrow, pending home sales, ECB, President Draghi is going to talk. So there is going to be a lot of news tomorrow. Meaning now then that if we have a trade, we cannot put our stops on a very, very tight stop because of the volatility what it can bring. So if there's going to always be an intention of the trade is very important. The purpose. What is the purpose of this trade? If we're going to say to ourselves it's going to be a more of a medium-term type of swing trade, then the stop has to be bigger, just in case that when these guys talk, especially Bernanke, that we're not going to get stopped out. But obviously bigger stops, smaller position size, someone who is more highly neurotic and is a risk averse, they won't be able to do that trade because they can't sleep, right? Well, the beauty about the currency market is that they will close the positions if they don't feel comfortable. Hence, they're now micromanaging the account, which we don't want as well. So that's a danger point. That's a danger part. But as a coach, if they do touch that trade, then they have to pay some form of penalty. Because that's also teaching them on how to be disciplined just by following the plan. Right. So, and then next step is looking at the dollar index. What is the dollar index? So then there's a brief description through there. The dollar index for us is very important because it dictates the value of the US dollar, again, based on the purchasing power of parity. This also dictates the equity markets. This has an inverse correlation with the marketplace, meaning that if the dollar keeps on going, hence the reason why I knew or I know that the market is going to drop to a certain level, to a certain point, is because of a breakout of the trend and the dollar is way too strong. And now with a big boost, the odds and probability that the market will come back down is highly probable. the odds and probability that the dollar is going to continue to go up to the upside and the major currencies will drop is highly probable, is because of this. And if you notice here, the euro has a 57.6% weight in terms of finding the actual, because it's a futures indicator based on the US dollar itself. So yeah, it's an awesome indicator, and this is pretty much a part of our tool belt. So the more information that we do have, the better for our analysis. Then we can execute the trade with more confidence and less fear. Right, so we need to analyze that next. Then we look at the futures index. The futures index, like the S&P 500, the Dow Jones, we need to look into those because they have to go hand in hand. So the meaning here, if you look into it, see how it is heading to the downside, the S&P 500, and you see here on the dollar index, here's an inverse correlation. It is awesome. They have to be hand in hand, but at one point in time, the markets are basically out of whack. Even in the currencies are currently out of whack at the moment. Okay, it is like something is being rocked. Right, Tony. Based on your trading daily setup, you seem to trade 152 or once a trade daily, once a day. Correct. So I'm a swing trader. But obviously, we have the live trading classes. So, whilst we're analyzing, we're also finding any potential trades on a shorter term time frame. We're also currently looking at potential trades for the next day, right? So, the trading result from what you saw are recommendations from both the daily trading routine that I do and the live trading classes at nighttime. Because at the nighttime, when with the members, if everybody agrees and they're analyzing, it has a high probability and it's really good, we all execute there and then, right? And sometimes I do coach them. I need to say, okay, let me have a look at what you're doing. They hesitate, and I need to ask them, so why are you hesitating? How come you're not entering? Everything is now showing the probability that it's going to go to where we want to be, then how come you're not executing? So hence, I'm creating the same type of an environment actually in the office in part of the Trader Dojo. So, but I'm making that more available, not just for the currency market traders, but also for stocks and futures. At this point in time, I'm not going to do options because I'm not an options expert. So hence is why there's no options. I can't coach them. All right. All right. So that's next step is now your futures index, and then step number 2 is now this is when we start to scope the market. All right. Scoping the market now is this. Since I showed you and shared with you method number 2, here's a great example. Okay, there's a pound yen. Okay, there's 1, there's 2 that basically executed. See, this is basically, these are the flaws of method 2, hence the 20% of what's not working. But then again, I always explain to traders that if it doesn't work, a number of days, 1 or 2, we just need to be aware, because even an uptrending market, when it's going to the downside, you can't go short, even though there is an entry to go short based on method number 2, because in an uptrending environment, the probability that it's just a form of a reversal pattern or a short-term correction is highly probable. Hence, there it is. This is a much more better way because the overall is an uptrend. We have a morning star. It is currently on the oversold right there. We have the trigger 141, 1585. The stop is being dictated. The target points hasn't been dictated, but did boom. See how from that essence all the way from the entry point, even you say you put in the closing price right there, 142.61. Even an uptrend, the trend is your friend. It is with you. Hence, from that 142 all the way 147. That's a 500 pip profit in 1, 2, 3, 4, 5, 6, 7, 8, 10 trading business days. So, you know, if you're making 500 pips, the advantage of being a swing trader is that less stress, less emotion. You're not looking at your screen all the time. You only look at it once a day. You know, each and every trade maximum per account. We only put 2 trades maximum in one day. I mean per account, not in one day. And hence, that's why it's imperative to have multiple accounts, one for short term, medium, and longer term. And the reason for that, and the way I say that, because the bigger the time frame, the better it is actually. In terms of the highly probability. Obviously from here, this is the financial markets being to, you know, the financial meltdown. So this one is just a correction, hence, you know, that's the flaw, but this is just mainly the tips of it anyway. To the downside, see like here, no, to the downside is a failure, to the downside, no, you don't want that, you don't want that, so there's nothing. Even actually from here to here on a big one, it actually took pretty much everything. So the bigger the time frame, the better it is. By the time you're getting to the smaller time frame, so you see an uptrend, that wouldn't work. It is seldom that they come on a bigger time frame, but there's more frequent when it comes to a smaller time frame. The pound yen, so nothing. So let's talk about the euro against the dollar. Let's see from euro if there's anything in the euro against the dollar. See, there's one, but it took 2 hours just to profit pretty much. There is one, but it's too small, so there is none. Okay, let's see on the daily. The yens actually, they did one. Okay, oh yeah, okay, here we go. Okay, so we know within the process, I go through a sample. So here's a method 2, this method 1, method 3, right? Here's currently I put some stars in there. There's a potential trade in terms of M2. So we can do this as an exercise. If the price by tomorrow approximately 12 hours, no, 24, about 22 hours from today. If the price will go a certain number, okay, let's do this one as an exercise. The open is 132.15. Okay, let me show cursor data. So trading journal. Okay, so this is very much the euro dollar. Yep, there's an M2 right there. So here's a potential M2. So you'll notice how the open is 132.15. The close is 130.58. 6. We add them up. So 1.3215 plus 1.30586. If we divide that by 2, that is the mean, that's the average. So the trigger is 131.54. So 131.54.3. Okay. 131.54.3. This is now the trigger. Okay, that's the trigger price. I'll change that into green. There's a point. I didn't enter the first number correctly. Okay, just 1 second, please. Okay, let me double check. The opening is 132.150, right? So still the same, 132.15. I just didn't put the 0 in between, the 5th decimal. Okay, let me double check that then. 132,150 plus 1.30586 divided by 2. Oh, lucky. Thank you. Thank you very much, Brad. Thank you for... So it's 131,368. Sorry, 131,368. Okay, 131,368. 131,368. Enter. There you go. Much better. Okay. So if the price by tomorrow is going to close above 131,368, then I'm going to execute. So that is going to be our entry price. If the low doesn't want to supersede this low, then as of today, the low is at 130.17. Okay, that's the entry. Low is 13171. Okay, minus the spread. The spread at the moment is 2.2, so I'll just say that 3. Okay, then the stop loss is 1.3014. Okay, that will be the stop loss. Okay, right. Let me put. It will be 1.3014. All right, here's now what about the target points. Okay, I'm going to use a fib. I'm going to find where's the last high. That is the last high of the move. Okay, here we go. T1 is at the highest probability. Will go to 131.32 is highly probable with the current price of 130.56. But the thing is, the price has to cross 131.36. So there's no longer valid. T1 will be 31.67 and T2 32.03. Okay, I'm going to put as a T1 will have the highest probability of winning. T2 will be the second highest probability of winning. And can it continue? I mean, it can go all the way to that last high right there, but since it's a downtrend, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. To go 132.03, perhaps that will take 2 days or probably 3 days in order for that to finish. But we need to wait until the closing price at the moment will close above 131.368. So that is the potential trade, right? So we can always look in tomorrow whether it will be the right one, and I can let you know. I mean, you can look at yourself too anyway on what happened based on that. All right, now let's go through the dollar yen. Is there any possibility? Nothing. Actually, same. If the price goes above a certain number through there, then the price can come back up. This will be a much better deal because it's on an uptrend if it chooses to by tomorrow. Pound dollar, nothing. See, or there's one entry right there, and actually that worked too. So from that entry point, okay, then T1, T2, and then basically failed. And that's a good one too. But there's nothing at the moment. Dollar Swiss. Dollar Swiss is none. There's nothing right there. Euro Swiss. There's also a potential one. Really nice bearish bar, indecision candle, way oversold. If the price crosses halfway point based on the open and the close, approximately about 122.30, and basically it can go long. Okay, Aussie USD, nothing. Dollar CAD. Oh, okay, dollar CAD has a potential to go to the downside. Okay, I'm sorry, since I didn't go through the methodology heading to the downside, same. It is a reverse. We need an evening star meaning we have a bullish bar, indecision, and a bearish bar. Calculation will be the same, that if it crosses the trigger below that, then you go short. Oscillator, stochastic is on the overbought. It's above the 80. Then it has some room in order for that to fill in the blanks around these levels right here. So dollar CAD is also a potential one. Kiwi, nothing, but there might be a potential depending on what we'll do the next day, but there's pretty much at the moment nothing. Euro, pound, there might be a potential one, but it's, I want that more to below through here, but it's just on borderline. Okay. Euro yen. So we looked at Euro yen earlier. There might be a potential one if it crosses a certain number, 122.33, way oversold. Also in an uptrend, so a much better probability if there's an M2. Likewise for the pound against the yen. There's a potential. It's an uptrend still, pretty much from last year. Obviously, we're in a lower low perspective. Now, part of this component, then it has to correct itself. If it corrects itself, there's an M2, then we're still, the probability of us winning is also very, very high. And then pounds with their exotic pairs, which we don't really look. So that's how I do it. That's how I look into it. And obviously, I have a cheat notes. This will be available to the public one point in time, but at this moment, no. They're just mainly for personal use, only for me and private clients. All right, so that's the methodology in terms of our trades. Okay, so the question here is where to from here. We're going to wrap it up. Okay, one is you can come into the Observer for free. You can be an Action Taker member. You can be an Elite Trader. You can come into the Trader Dojo. Part of that you can see through on our pricing. The Action Taker, right, is $149 a month. The methodology you saw there, you can, since I shared with you, there's a SMS pattern recognition method. There's a weekly group coaching, more of a online environment once a week, 5 days trading, and 5 days a week that you guys can come in from 11 to 12 Pacific Standard Time. Copy of my book, the trade alerts. So if you can't make it to any of that, you can still get the alert system anyway. Weekly market updates that you also get for the free for the Observer. And the daily trading routine. So in other words, you got 2 classes that you can come in a day, right, if you choose to. And then for those who are working, couldn't do more of the trading, we just like the alerts, then it's pretty much 40 or 50 bucks about a month. And then the Observer. And then the coaching 101, Elite Traders. For the US, the UK only, unfortunately. You basically get a free laptop and load pretty much all the information needed based on that, and pretty much that's your trading computer too. That's currently being used, so or that you're going to use. And then the other one is if you live in the Bay Area, I will be basically in the office twice a week from 11 to 1. So you can come in more on a one-on-one type, but it's going to be on a group coaching. I can only fit up to 12, but it all depends on how many strings I'll get. Then I get the smaller boardroom or the bigger boardroom, depending on how many are going to come in per day. So basically, it's still on a coaching environment, but it's not just the Forex part, but also stocks and futures. And obviously, guiding you guys as well, helping you with your trading system or probably your trading checklist to make things a little bit more better. Yeah, and I'll be behind you. Basically, it's like driving a car, right? So if you have a potential trade, you come up with potential trade, we'll look into it, we share whatever potential trades that there might be within the group, all the type of stuff. So is it a pay-as-you-go, the weekly, and monthly? So since it's new, I'm just testing out, the price is pretty much reasonable for now. Okay, any questions for me? So those are the ones. I hope you guys learned a lot from today. I know there's I needed to go through the foundation first and then bit by bit in terms of the currency markets. And if you don't have any questions, then I'm gonna unmute actually everyone. So any questions from me? No worries, Jess. Thank you for coming. So there's no any questions. We'll wrap it up. Thanks a lot, guys. I will send out the video to use. I know if that's a challenging part with webinars, online webinars. Sometimes the concentration span is only about 45 minutes. Thank you, Stephen. Thank you, Umberto. No worries. Thank you, Jill. I'm glad you enjoyed the class. But next month we're gonna go through back to basics of technical analysis through the third part of the Ultimate Trader. Okay. Thanks, Edwina. Have a good day. Thank you, Tony. Hope to see you one of these days. And thanks, Vern. Thanks, Barbara. Thanks, Erica. Thanks, Edwina. Thanks, Ed. Thanks, Brad. And you guys have a great night. Take care. Until next time, happy trading.